So, Synchrony Financial. Now, since I've added this company to my portfolio about 5 months ago, the price has gone up close to 60%. And of course, I like to pull out cash from the companies that I have ownership in along the way while I own them. And Synchrony actually pays a nice dividend as well. So let me put some respect on it with a proper introduction. Now, chances are a lot of people haven't heard of this company just yet. But after you watch this 2-part series, you'll be well acquainted. I'll break down Synchrony Financial and walk you through my process of analyzing the company. And from there, you'll see why I decided to buy it and add it to my portfolio at $24 a share. And listen, some of the things you find out about this company might surprise you. And at the end of watching this 2-part series, you might even consider adding Synchrony Financial to your portfolio. Now, all of the tools that I'll use in these 2 videos are Yahoo Finance, Synchrony Financial's annual report, which is just the 10K report with some additional information from the company's leadership, Synchrony Financial's 10Q report, and macro trends. And first things first, we need to pull up Yahoo Finance to see this figure right here. Now see, this is my first filter. It helps me to weed out the thousands of companies that I feel aren't worth a deeper look so I can focus in on the ones that are. If I see a company with an astronomically high PE ratio, I automatically move on to the next. Because when you pay too high of a price for even a great company, you're increasing your chances of losing money. And I don't like to lose money. The same thing goes for those companies that don't have a PE ratio because their earnings are negative. Next, and we saw that with Synchrony Financial or mini Synchrony, if you chose to buy it, then in the last 12 months it earned $2.23. And of that $2.23, you got to pocket 88 cents to spend it however you please. And to get these 2 things, the price tag was around $38, giving it a price to earnings ratio of around 17. Now, that's not incredibly low. I bought it at 8 times earnings, around $24 a share. But it does pass our first filter of this figure not being astronomically high or non-existent. And now that we got that out of the way, we need to figure out what in the world is Synchrony Financial. So basically, what do they do and how do they make money? And for that, we'll pull up the annual report. And here's where we can see the company overview. So you see that it is a consumer financial services company, delivers a range of specialized financing programs, as well as a range of credit products. And here is an important sentence right here. Through our partners, over 410,000 locations across the United States and Canada, and their websites and mobile applications, we offer their customers a variety of credit products to finance the purchase of goods and services. So it's a financial services company. So they generate their revenue from issuing loans or lending out money and then charging interest to those who borrow. Cool. But if you so happen to pause the video on that previous screen and read on, it might have been a couple things that caught your attention. 1, this sentence right here, last sentence, first paragraph. Our active accounts represents a group of consumers with an average FICO score of 719 for active accounts at December 31st, 2019. Now, this is good because the nature of the business is to lend out money, and their success depends on people paying back what they borrow plus interest. It does the company no good if people borrow money, but don't pay it back. And the average FICO score of 719 means that they're primarily lending to those who will be able to pay them back plus interest. Now, as for the other thing that might have caught your attention, this sentence right here, first sentence, second paragraph, talking about Synchrony Financial's collaborative relationships with partners such as Lowe's, Ashley Home Store, Amazon, and PayPal. Big time. Now, these are some big time names with some big time partnerships. They represent value for the company. But more on that later. For now, let's look at the numbers a bit, the money, and see how revenue and earnings have trended over time. And for that, we'll go over the macro trends. Now, in Synchrony Financial's revenue chart, you can see how revenues have trended upward over time, which is a good thing. But in the last 4 quarters, they've trended downward. And this is largely due to the headwinds from the impact of the coronavirus and the shutdown of the economy, which is justifiable, but definitely something to keep an eye on. Now, navigating to the earnings screen, earnings per share screen, we can see the story of how earnings were relatively flat for a few years, then experienced some growth right here. And again, this is a good sign, but the earnings have dropped in the last 3 quarters following the trend of revenue. Again, coronavirus impact, so it's justifiable, but again, just something to keep an eye on. Okay, cool. So we looked at Synchrony Financial's revenues and earnings and how they've trended over time. And we now have our eyes on what we should be paying attention to in the upcoming months. Will the company continue to experience downturn in revenue and earnings, which wouldn't be a good thing? Or can they start to improve these periods despite the downturn in business due to the coronavirus? Now, Synchrony Financial releases its next earnings report in a couple weeks on the 29th. And that's where we'll be able to see how revenue and earnings have performed in the last 3 months since the last quarterly report. Now from here, we need to do a quick analysis of the company's financial statements. Remember, we're business owners and potential investors, so we need to do our due diligence in finding out what the company's money looks like. So the 3 main financial statements are the income statement, the balance sheet, and the cash flow statement. We'll end this video off by looking at the income statement, but in part 2, we'll look at the other 2 financial statements and then look at some other factors that will help us make an investment decision on Synchrony Financial. Now, as for the income statement, Yahoo Finance. Come on. This is how you navigate to the income statement via Yahoo Finance. So click on the Financials tab, and then it'll be the first one that pulls up. Now, the income statement is important because it shows you the dollar amounts for the company's revenue, its expenses, and its net income. Companies also include the total number of shares outstanding and the earnings per share on the income statement. So by looking at the income statement, you can start to build your story as to the company's financial strength. If the story looks good at this point, then you'll start to feel more confident in investing. And if not, then back to Yahoo Finance. Now, in 2019, you can see how the company profited $3.7 billion in net income off of total revenue of $17.1 billion, giving the company a profit margin of about 21%, which is pretty high, and that's a good thing. But I want to emphasize an important concept here. Now, in my video on profit margin, I spoke about how companies with a high profit margin have a bit of a cushion in the event that business hits a rough patch. So if you haven't watched that video or you just need a refresher in order to help you understand that concept, then definitely go back and watch that video. I'll link it down in the description below. And of course, I break it down simply and practically. Now, we saw how the company had a high profit margin of around 21% in 2019. So when the economy shut down and business slowed up in 2020 due to the coronavirus, this 21% profit margin gave Synchrony Financial a cushion so that it wouldn't easily turn up unprofitable in this next year. So in the trailing 12 months, the company's revenue took a hit of about $2 billion, dropping from $17.1 billion to $15.1 billion. But the company was still able to turn a profit of $1.3 billion as opposed to a loss. Now, the profit margin has gone from around 21% in 2019 to 8% in the trailing 12 months. But again, it was an unforeseen virus that led to a downturn in business, so it's understandable. And finally, to end off our income statement quick analysis, we can see that besides the trailing 12 months, in the previous 3 years, revenues were trending upward and so were earnings. So the company was getting more and more interest on loans and increasing its profit, which is a good thing. And that's it for part 1. We'll finish our analysis of Synchrony Financial and think about an investment decision in part 2. Listen, the moral of the story is if you invest in great businesses and buy them at great prices, the money is gonna come. This is business, and I'm a businessman. Make sure you watch part 2.